How does an SPV work in the securitization process? Imagine turning a bunch of loans or receivables into a package that investors can buy. That's where a special purpose vehicle, or SPV, comes into play. It's a separate legal entity created just for this purpose. When a bank or financial institution wants to sell off loans, they transfer these assets to the SPV. This move keeps the assets apart from the bank's own finances, protecting them from any financial trouble the bank might face later. Once the SPV has the assets, it issues securities backed by the cash flows from those assets. These securities are called asset-backed securities or mortgage-backed securities. Investors buy these securities, and in return, they receive payments from the income generated by the assets, like loan repayments or lease payments. The SPV acts as the middleman, collecting the money and passing it on to investors. A key feature of the SPV is its legal separation from the original bank or institution. This separation is called bankruptcy remoteness. It means that if the bank goes bankrupt, the assets held by the SPV and the payments to investors are protected. This makes the securities more attractive because they are less risky for investors. The SPV also structures the securities into different classes or tranches. Each tranche has a different level of risk and priority for receiving payments. Some investors might prefer safer, lower-risk tranches, while others might go for higher-risk, higher-reward options. To keep everything running smoothly, a servicer is appointed to manage collecting payments from the borrowers, and a trustee oversees how the cash flows are distributed according to the rules set out in the security agreements. Historically, SPVs changed the game in financial markets. They made it possible to turn assets that couldn't be easily traded into securities that could be bought and sold in markets. This process helped financial institutions manage risk better and access new sources of capital. It also gave investors more choices and increased overall market liquidity. In simple terms, an SPV works by taking assets off the books of a bank, issuing securities backed by those assets, and managing the flow of payments to investors. It acts as a shield, protecting the assets from the financial issues of the original institution while making it easier to transfer risk and raise funds in the financial markets.